Investing, when done wisely, is a great way to grow your wealth and secure your financial future. However, new investors often make mistakes and end up losing money rather than gaining it. In this article, we'll discuss the most common mistakes new investors make and how to avoid them. One of the biggest mistakes new investors make is not doing enough research before making investment decisions. They often get swayed by what is popular or what their friends or family members have recommended without digging deeper into the investment's pros and cons. This can lead to investing in the wrong assets or stocks that don't match their investment goals. To avoid this mistake, new investors should develop a solid investment plan and research potential investments carefully. They should analyze factors such as the company's financial statements, their revenue and profit margins, and their industry trends. It's also important to keep up with the latest news and developments in the market that could impact their investments. Another mistake new investors make is not being patient with their investments. They often expect quick returns and get impatient when they don't see the desired results. This leads them to sell their stocks too soon, missing out on potential long-term gains. To avoid this mistake, new investors should understand that investing is a long-term game. They should focus on creating a diversified investment portfolio that includes both short-term and long-term investments. They should also have realistic expectations and avoid making impulsive decisions based on short-term market fluctuations. New investors often think that they can outsmart the market and make better investment decisions than experienced investors. This overconfidence can lead them to take on more risk than they can handle or invest in assets they don't fully understand. To avoid this mistake, new investors should understand their risk tolerance and stick to their investment plan. They should also seek advice and guidance from experienced investors or financial advisors. Another common mistake new investors make is following the crowd and investing in what's popular or trendy. This can lead to investing in overvalued assets or stocks that are not a good fit for their investment goals. To avoid this mistake, new investors should do their own research and due diligence before investing. They should also focus on investing in assets that align with their investment goals and risk tolerance. New investors often try to time the market, which means buying and selling stocks based on market trends and predictions. This can lead to making impulsive decisions and missing out on potential long-term gains. To avoid this mistake, new investors should focus on creating a diversified investment portfolio that includes both short-term and long-term investments. They should also avoid trying to predict market trends and instead focus on investing in assets that have a strong track record of performance. New investors can avoid making costly mistakes by doing their research, being patient, avoiding overconfidence, focusing on their investment goals, and creating a diversified portfolio. They should also seek guidance and advice from experienced investors or financial advisors. By following these steps, new investors can achieve long-term success in their investing endeavors. Have you made mistakes as a new investor? Comment below. Thank you for visiting Free Market Economy.